Welcome to Infobriefs, where we use cutting-edge AI technology to bring you a balanced view of breaking news and current events. Our goal is to provide you with insightful analysis and comprehensive coverage, ensuring you stay well informed. Please like, comment, and subscribe to our channel. Your engagement helps us grow and continue delivering quality content. Thank you for your support. Now let's dive into today's news. This week, the economic spotlight is firmly on the Federal Reserve as new inflation data rolls in. These figures are crucial as they have the potential to shape the future of interest rate adjustments, impacting everything from mortgage rates to the cost of borrowing for businesses. Inflation is a tricky beast to manage. While moderate inflation is often seen as a sign of a healthy, growing economy, too much inflation can erode purchasing power, making everyday goods and services more expensive for consumers. The latest data suggests that inflation pressures remain persistent, despite previous rate hikes by the Federal Reserve. This ongoing pressure raises questions about the effectiveness of past measures and the potential need for further action. This situation puts the Federal Reserve in a tight spot. Should they increase rates further to dampen inflation, risking a slowdown in economic growth? Or should they hold steady to avoid stifling the recovery, even if it means tolerating higher inflation for a bit longer? A key element in this complex equation is the market's expectation. Investors and analysts closely watch the Fed's moves, and their expectations can influence market behavior even before any official decisions are made. Currently, the consensus among market watchers leans towards the possibility of only 1 or 2 rate cuts this year. This cautious outlook reflects the uncertainty and the delicate balance the Fed must maintain. This approach contrasts sharply with the actions taken by central banks in the European Union and Canada, which have been more aggressive with their rate cuts. These differences highlight the varied economic conditions and policy responses across the globe. Let's talk about the US dollar, which remains strong, perhaps too strong. A robust dollar has significant implications for the economy. On one hand, a strong dollar benefits American travelers and consumers buying foreign goods, as it makes prices abroad relatively cheaper. This can lead to increased spending power and more affordable vacations. However, the flip side is that U.S. exporters face challenges. A strong dollar makes American goods more expensive overseas, reducing their competitiveness in global markets. This can hurt sales and profits for companies that rely on exports. Historically, we've seen similar scenarios where a strong dollar has both short-term benefits and long-term complications. For instance, in the 1980s and 1990s, a strong dollar led to trade imbalances and required adjustments in monetary policy. While a strong dollar can be a short-term boon for consumers, it can complicate longer-term economic strategies. Issues such as trade balances and monetary policy become more challenging to manage, requiring careful consideration by policymakers. As the Federal Reserve convenes this week, all eyes will be on their analysis of these complex dynamics. Their decisions will be scrutinized for indications of how they plan to navigate these economic challenges. Will the Fed signal a cautious approach, maintaining current rates to observe further economic data? Or will they surprise the market with a bold move, either raising or cutting rates more aggressively than expected? The answers to these questions will undoubtedly ripple across global economies, influencing everything from stock markets to international trade relations. The Fed's decisions are not made in isolation. They have far-reaching consequences. Thank you for visiting Prismatic Soul's Palladian. We appreciate your time and attention. Please like, comment, and subscribe to stay updated with our latest analyses. Stay curious, stay informed, and we'll see you next time.